Hi, this is Charlie giving you Thursday's video. Hope you're very well. And I think I titled the video today having a 99% success rate. And the reason I've done that is because you hear of you know trading companies touting this sort of stuff to get people to go and pay to go on their courses and stuff. And there was a company that I think it was only a year ago. I was at a trading show, and they were touting it was either a 98% or 99% success rate. Now, I obviously not aware of it. It's just only when your clients come over to you and they say, "Oh, there's a company over there that's doing this," and effectively, what they were promoting was something like something like this, having a stop loss of like 800 pips, and targets of sort of 20 pips, 10 or 20 pips, and they were so yeah, so that gives us our 99%. We're right 99% of the time, and or whatever it is, 98%. And you think, yeah, you probably are, but when you get it wrong, you lose everything, and you lose the lot. And it's one of those things where that will lure newer traders in, because they'll be like, wow, I can trade and be right 99% of the time. Yeah, I'll have some of that. They don't really think about this too much because they just go with the maths and say, yeah, fine, have a big wide stop and lots of 20 pippers, and I'll only be wrong, once in 100, and that's okay because all these 20 pippers will pay for that, which is true if it works. But the problem is what happens if you get two losers all of a sudden come across. It's just nonsense. It's absolute nonsense stuff. It's like there's another educator out there I've heard about who advocates adding in up to never being wrong, and advocates adding in up to 17 times to a losing position. So adding in 17 times, and says that you can never be wrong. Well, I don't understand why you can't be wrong 18 times, or sorry, it doesn't keep going down, and that's the problem. Again, when you're relying on some sort of probability or stats, the problem is that in the markets don't adhere to that. Not all of the time. There's always going to be that standard deviation event, which is way beyond anything you've back tested, and it will always come along. And so, yeah, you could get away with this again with this type of trading for a fair amount of time. And but if all of a sudden you get to that point where, oh, hold on a second, it's gone even further, what do you then do? You end up taking an excruciating loss. And these are the things that become account killers. And if you've not read the book, the hour between, the hour between, excuse my writing here, the hour between dog, not the dog, but just dog and wolf. There's no the in there. I would highly recommend it because the guy who wrote that book was an ex-Wall Street banker, but it was also had a first-class degree, and I think he had a doctorate in biology as well. And what he did is he took all the things that traders do and looked at their biomechanics as well, and biology into account to actually say what's actually going on at a biochemistry level. And so that was a fascinating book. And part of that book, he was talking about traders that get themselves into too big of positions to get themselves out of holes. And there wasn't, and all the testing they did with all these traders, they said you could have a trader who could be winning 1, 2, 3, even 4 or 5 years in a row, but doing the wrong things. So either over leveraging, adding into positions like this up here, indiscriminately. I mean, I build positions, but within a small framework sometimes on a trade. So you might have an entry. Market might be coming up like this, and you're looking at a pullback. So it comes up to the first level, you put an entry in, comes back to the second level. You've already accounted for this by putting a smaller position in here, and then another small position in here, and then hopefully away it goes over there. So you're still trading within your sort of 1% risk rules. But anyway, this sort of trading up here with adding in and or the other traders with the 99% stuff, um, ultimately, and what he found in this book is that there's not a single instance where ultimately they don't blow up. They blow their accounts. So what my point is what's the point in doing that stuff if yes you could be right for a year, maybe 2 years or three, or whatever, if at some point, and you don't know when that point's going to come, you're just going to lose it all. You're going to absolutely just get cleaned out. So it's a pointless way of trading. It's great for the trading educators because they've got you on board. You start making some money. You give them some testimonials, but ultimately you are going to blow up by doing that sort of thing. So interesting stuff that's out there, and as always, and there's loads more that I get told about. But these are two instances recently that I've sort of heard about, and but I would highly recommend this book. It can be heavy going. It's by a guy called John Coates, by the way. It can be a bit heavy going, but persevere with it because he is a biologist after all, and there's a lot of in-depth stuff in there, but well worth reading because you learn a lot about yourself within reading that book as a trader. I shall leave that with you. Have a great day. I'll be back tomorrow for live trading.